Good morning. Welcome to IG's early morning call. It's Friday, 22nd of December. We are on a half day today across many of the European markets. Let's take a look at the headlines as we await the start of today's trade, where we're looking for small losses pretty much across the board. But it's been another day of inflation data and another day where we've seen a deceleration, this time coming through in Japan, where the consumer price index decelerating, easing pressure on the Bank of Japan. The US dollar has hit a 5-month low. I was talking yesterday about an inverted pennant pattern, which is paying dividends, all this coming ahead of US core PCE. Nike shares late last night on the IG platform. It was all on the way down, almost 12% lost in extended trade last night on the IG platform that we saw the company come through with a warning of a softer outlook for revenues for the second half of the year. And oil prices, we continue to monitor what's happening there with concerns about the supply side and the potential disruption because of what's happening in the tensions around the Red Sea, geopolitics raising its head once again on oil prices. Look at volatility. We're holding on to the gains that we've seen recently, currently trading at 1566. This rise that we saw in the last few days or so has seen a little bit of money taken off the table in terms of equity markets. That is apart from what's happening here in London. And one of the reasons I think as to why we've got London up is because we've seen a rise in the price of oil. I'll cover this in just a few moments' time. But broadly speaking, has been a particularly good run for London because of the exposure to the oil sector. Although you can quite clearly see now here the drop today. And we've got confirmation in the last half hour that the UK is edging back once again towards recession. We'll take a look in some more detail in just a minute, but we haven't yet quite got there. The recession, technically speaking, is two contraction quarters back to back. Yet got that, but oh boy, we're very close after a second quarter revision. But the broad sweep of things is we're expecting a lower start in the London markets at the top of the hour. Same sort of thing on the German DAX after those recent record highs, a drop in today's session down at 16,662, and the French CAC 40 as well on a little bit of a pullback. And we are down at 75.67 as the markets prepare for the half day's trade as we await that long weekend for Christmas. Let's look at what's been happening overnight in the Asia-Pacific markets, where we've seen the Nikkei 225 end the session on what was a mixed day overall, up by a margin of almost 0.1%. Outside of that, it's not really been particularly encouraging. Hang Seng Stock Index down 1.65%. And the S&P ASX 200. Just one stock I wanted to show you on the Hong Kong Stock Exchange. This is Tencent, extending its drop to the margin of 13.25% today in Hong Kong after China announced curbs in the gaming sector. Gambling, its feeling, is getting a little bit too extended in China. It says that online games particularly should be curbed, should not contain inducive rewards when people are online gaming, especially at home, out of the regulatory environment. In certain areas where we have public gambling, and of course Macau is a big area, but nonetheless it is hitting stocks like Tencent down heavily on the session in today's trade in Hong Kong. Let's take a look at what's been happening on the US markets as of yesterday's close. We saw gains across the board, up 1.25% for the Nasdaq, S&P 500, Dow Industrials, all showing gains as at the close of yesterday's session. I want to show you what's happened in the context of what happened earlier on in the week. On Wednesday, we saw this big pullback. This is the Dow. This red dotted line was the previous record high at 36,950. We're currently trading at 37,281. So we're holding on to those gains and not too far away from the record highs. So that pullback we've seen over the last few days, it's really just all been about some of the money taken off the table. S&P 500, same sort of price action, but we haven't yet hit that all-time record high that we saw in this market back in January 2022, but very close. But the Nasdaq, where we saw these pure growth play stocks lifting up to a new all-time record high in the last few days, and a little bit of a pullback. But today's session, we're currently trading 16,711, pretty much the top of the chart or the top of the candle from yesterday's gains. Now, let's return back once again to this look at what's been happening with inflation. We've seen inflation down against a whole regions of the Western economies, the big developed economies here in the UK recently, the US, France, Germany, Italy, Spain. And now in Japan, the headline core CPI number coming in, falling to 2.8% in November from 3.3% in October. The core consumer price index, this excludes volatile fresh food, but it includes fuel costs, rose 2.5% in November year on year. Now that matched the market forecasts and slowing from a 2.9% gain in October. It was the slowest increase since the 2.4% growth marked back in July 2022. CPI, excluding food and energy, the so-called core CPI number in Japan, the BOJ favoured reading, came in at 3.8%, down from the previous month's number. This latest set of data eases the pressure on the Bank of Japan and may give the central bank some more time before phasing out its massive monetary stimulus and easy monetary policy. The Bank of Japan keeping its ultra-loose policy intact last Tuesday, and Governor Kazuo Ueda left no hints of an early exit from that easy monetary policy. Following up on what's happened recently with the dollar yen, the dollar down at levels not seen in some 5 or 6 months or so, 7th of August. We have been lower than this in the last couple of weeks or so, but nonetheless, it keeps the pressure on. This is the Japanese yen rising against the dollar, or the dollar falling against the yen, I should say, in the terms of the picture of this chart. But this does give the effect of a stronger Japanese yen. Meanwhile, here in the UK, two bits of interesting data out: retail sales and GDP. I want to follow up on the GDP first of all, because the final reading for the third quarter has come through in contraction, with a 0.1% contraction quarter on quarter. Now, this shows that the UK economy is on the brink of recession. GDP down, and the second quarter has now been revised down. We had previously seen an estimate for the second quarter of an expansion of 0.2%, but that's now been revised down to flat. So there was no growth in the second quarter. So we are very close to going into the recession. Although that second quarter number doesn't actually steer us into a technical recession in this third quarter, we will still have to see a fourth quarter contraction if that comes to pass. Now, onto retail sales. Now, this has been better than expected. Now, this is the one thing I think that potentially, or one of the things that could potentially take us back up into a positive GDP number. I'm not suggesting that retail sales in itself is something that's really going to steer the economy around, but it is something interesting that if people are going to continue spending, then that does help. The downgrade on GDP, I should say, is because the UK services sector is now estimated to have fallen by 0.2% in the third quarter, contracted of this year, revised down from a first estimate fall of 0.1%. So that was all to do with the service sector. But when looking at that retail sales number coming in far stronger than expected for the month of November, it does mean that people have been out spending. It's been slightly warmer than some people had expected. Let's take a look at what's happening on the foreign exchange markets for sterling. This is where we are on the moves that we've seen for the pound against the US dollar. We are up in today's session. I'll show you what's happened in 5-minute candles, just to show you when the news broke. And in fact, it was a positive swing here for sterling. Part of it, I guess, is because of what's happened to retail sales. The GDP number is, to be honest with you, relatively backward looking, but nonetheless, it does have an effect and will hit the headlines tomorrow. That when you see the newspapers, I should say, but the headlines are already saying the UK is on the brink of recession. So that is the news. But nonetheless, sterling has strengthened against the US dollar in those 5-minute candles that we've got. So this rising line of support is enduring. If you continue to be long on sterling against the US dollar, your stop is underneath that rising line. So you're stopping around about the 126.20 level. 126.93 is where we're trading. There is a little bit of a headwind above where we are up here, which is 127.94, not too far away from the 128 level, which is obviously going to be the next area of resistance to watch out for sterling against the dollar. Talking about the dollar, we got some economic data out later on today that could well help give us a steer on what's happening with dollar trades against the euro, against the yen, against sterling, or whatever it might be. We got the US Fed's preferred measure of inflation, the PCE price index, expected to rise by 0.2% in November month on month. Durable goods orders expected to rise 2.2% in November, and new home sales forecast to rise 1.2% in November month on month. I want to show you what is happening to my trade I was talking about yesterday. My trade idea yesterday was to go short on dollar basket, and that's ticking out nicely, actually, with a drop down outside of this. We are now, technically speaking, having completed the symmetrical triangle here, But I noticed that there was this little handle here of what is essentially a pennant pattern. That handle I've drawn here with an arrow. The extension of that arrow would take us down to 162. For those that trade symmetrical patterns, then, as I say, that is now over, and we've now met that. So that is in itself a completed pattern. But I think because we had such a strong down move here, giving us a little bit of a handle to the pennant, I'm expecting that to continue down here at 162. But in the money at the moment on that trade that we've been seeing for the dollar basket. Now, of course, the dollar basket is essentially an inverse of what's happening with euro dollar. That being said, this now is knocking higher. In fact, in yesterday's session, the highest we've been intraday, we've seen since the 29th of November. But the closing market yesterday at levels that we've seen on this market, not seen since the 8th of August, 110. 0.02 is where we are, so we're now up above the 110 level again for euro dollar, showing us potentially there is further upside to go. If you're long on this, this is your price target up here, with the highs we had back on the 18th of July at the 112.75 level. If you're long at 110, stop goes underneath the 109 level with a view to taking that up as well. Now, just one breaking news headlines coming through from the corporate world, and that's involving HSBC. I want to bring up the chart of HSBC in the London markets in the context of what we've got for the company, because Canada has approved RBC's $13.5 billion acquisition, Canadian dollar acquisition, of HSBC's domestic unit in Canada. That's around about $10.2 billion, about 7.98 billion pounds. HSBC expects to close the deal in the first quarter of 2024. But I think potentially this could well be a positive stock story. The bank said it's considering a special dividend of 21 cents a share from the proceeds in the first half of 2024. So that's a good reason to buy into HSBC stock at these levels at 622. This rising line of resistance that we got here kicks in just a little bit above where we are, 4 or 5 pence above there. You get a break of that. And then it's a question then of closing this gap up here. Let me just show you where the gap will close. 638.7. So we've got around about 14 pence in the bag before we get to that level. But that's the sort of price target area if you're long on HSBC going into the start of today's trade. Meanwhile, it was all negative pretty much yesterday on all sessions on the IG platform after the close of the US markets, around the story coming through from Nike, the sportswear manufacturer. Shares down 11% after the bell last night after a disappointing revenue forecast. These are the numbers. Second quarter earnings per share, $1.03. Now that's 19 cents better than the analyst estimate of 84 cents. Revenues for the quarter coming at 13.4 billion, not too far away from estimates. Nike also unveiled plans to cut costs by around about $2 billion over the next 3 years, because it's warned about a softer revenue outlook from the second half of next year. And this is the reason why we saw this big drop in shares. If you look at the share price chart, this is all after the bell last night. So you can see this is where we're going to be starting today's trade. I've drawn this blue box on here to show you what the uplift has been since the last quarterly results, when there was uplift in its shares. 28th of September, Nike came through with a really positive outlook and a 42.2% increase in Nike shares since that point. But this pullback today is a real drop or real kick, I should say, in for those investors who've been riding that ride up. It was really left field, this news, I think, last night. And when we saw the stock pull back, it was quite clear that there was concern about the outlook. And we've seen this for a number of companies operating in the consumer sector. Let me just show you what happened on an hourly chart, so you can see absolutely off the bell last night when the numbers came through. That's what happened for Nike. The company says it has plans to simplify its product assortment, increase automation and use its technology, streamline the overall organization and leverage its scale to drive greater efficiencies. That's Nike. That's the outlook for the business. Now, oil prices set to post a second weekly gain as global trade is disrupted through the Suez Canal, which handles around about 12% of world trade. The concerns are that the Red Sea carriers are avoiding the Red Sea because of attacks out in support of Palestinians by the Yemeni Houthi militant group. And as a result of that, we've seen the rise in the price of both Brent and also WTI. This is Brent. We're up almost around about the $80 level, 79.73 for the price of Brent at the moment. So this continues to rise on the back of those supply concerns. And there's a nice round number as well, or relatively speaking, for US crude, $75 to watch out for. We're currently trading at 74.51. If we see a continuation of the uptick in geopolitical concerns in the region of the Suez Canal and the Red Sea, I think there's more upside to go for both Brent and US crude. Let me take a look at what's happening in spot gold. Pretty much holding on to all of the gains that we saw yesterday on the back of that weaker dollar. And we're now back up at the 2050 level for the price of gold. And another trade idea I was talking about this week has still yet to come about. Now, I've drawn all the annotations on this, expecting this inverted head and shoulders to complete. It hasn't done so yet. If I pull up this is on PRT, Pro Real Time, by the way, so it does allow you to shift around things here. If I was to pull this up, you can see that we do have this neckline. Let me get rid of the horizontal line there. The neckline coincides pretty much with the highs we had back on the 1st of December. And the break of that would be 86.50. We're currently trading 86.07, so not too far away. We are traveling in the right direction. When we get a candle close beyond the neckline, we're then long all the way up to the 94.06 level as a result of the inverted head to the neckline I've drawn here. I've just copied that dotted line up there and projected that. And that would give us a level of trade here not seen then since the highs back in January 2023. So that would be a one-year high for the price of copper. Technically, I think there is an interesting trade here. Fundamentally, there is expectations that with the drop in interest rates next year, there is going to be an uptick in demand for copper. So I think fundamentals agree with technicals on this occasion. It's going to be a long play. But just keep your stop loss tucked in underneath you to give you some protection. You don't want to get stopped out, though. You don't want to make it too close. So I think this week what I've been talking about is a stop loss below the 200-day moving average down here, just below the 8,400 level. We're currently trading at 86.07. So that's something else worth watching at for the new year. That's it from me. Off now for a long weekend, of course, as indeed are many people. I will be around for charting the markets at 10 this morning, taking a look at some more of the charts and some more of the detail around some of the technicals on some of the charts I've been talking about this morning. And also looking at what we've got in terms of some of the volumes, because they are expected to be down today. We're only on a half day's trade today. And of course, here in the UK, we don't get back until Wednesday next week. Now, Wednesday, Thursday and Friday next week, if you are with us for the early morning call, what we're doing is we're doing something at 9 o'clock in the morning, which will bring together charting and the early morning call. We'll do one bulletin at 9 o'clock in the morning. So we'll bring everything together and do that on Wednesday, Thursday and Friday next week. Half day's trade, not just here on this side of the Atlantic for many of the European markets, it is as well for the US. Back we beat the street at 1:30 today. We'll be going through all that again for some of the US stocks to watch out for. Nike's bound to be one of them. We'll see how all sessions gets underway at 9 o'clock this morning in Nike stock, but certainly a lot of pressure being brought to bear on concerns about the outlook. I'm back at 10:30 for Charting the Markets.